we research about main topics like can be DeFi to use it for strategies like what I'm going to show right now. So basically today, this is going to be based in stablecoin farming. So basically it's to get in the highest yield, what we call yield or interest, the highest interest from your stablecoins, which is way bigger than what you can get in a bank account. So this is to prevent this basically, because everybody in this industry is always trying to be too long, too exposed to the price. And if you are farming with stable coins, basically, you can basically lock some upside without having downside in price. So let's do it. Basically, yield farming, the name is coming from like harvesting the yield. Basically, you are moving your capital to different farms that we call, so they are decentralized applications. And basically what you are trying to be is the most capital efficient and to get the highest yield with the lowest risk possible. So I will start with the biggest of all in DeFi. I tell you that these interfaces, they can be sometimes a bit intimidating, but I will do my best to explain it to you. Basically, here you can deposit assets like in a bank account, and here you can see the yields. And this protocol is considered like basically is like the central bank of DeFi. This is the safest. This has 25 billion inside. If you think about that size, 25 billion is a massive incentive for hackers to go and try to steal it. And this has been here for very long. So basically this is like a 6 stars level audit, since every hacker in, let's say, they tried to hack this protocol and they couldn't. So basically, this gives a massive safety. Here, a very common practice basically is just you can provide assets like it can be Ethereum and you can borrow stable coins against it. So basically you can have both. You can have the upside of Ethereum and you can have the stable coins if you want to spend them or if you want to invest them somewhere else. Here I can tell you a small trick. That is basically, you can see this pool is incentivized, USDC. Here you can get 10%. In my opinion, this one is pretty safe. In general, none of this is financial advice, of course, because this is Maker protocol, MakerDAO, but they rebranded to this new brand. So basically, it's a very old and huge protocol. And here, this is the PayPal USD. This is made by PayPal. And basically, it's 8%. Both of them together. Maybe these yields, they are not so amazing, but this is the safest of the safest protocol. Here, this is a different style. This is basically a decentralized exchange, like it can be Binance. And basically, what you are doing when you are supplying stable coins here, you have this return right now, which is pretty high. Basically, this is used for the market makers. So instead of Binance having private market makers that they are making a ton of money, basically, we, the users in DeFi, we can put the money, and the automated market maker is like putting liquidity in the books. So basically, that's enabling a better trading for all their users. Let's go to the next one. This one is interesting. This is a KYC platform. So basically, this is kind of permissioned platform. You need to submit your documents and everything. But here we can say that that's safer in some way because of that, or I wouldn't say safer, but some users, they can prefer this kind of old school style where basically everything is based in contracts. Here you have several flavors of vaults, corporate warranty, digital assets. Actually, in my opinion, this is higher yield, as you can see, but in my opinion, this is a bit less safe than Aave, and I will tell you why. Because even if these contracts are secure, I mean, all of them, they are different, I'm generalizing, but let's say that often there is an institution in the background that they can blow up and they can go bankrupt. So basically, maybe not all the money of the lenders would be recovered. when the process in Aave is basically automatic and algorithmic, let's say. So if someone is not solvent, will get liquidated automatically, basically. But this is an option, and you can see you have higher yields with different kind of collateral. Collateral, I mean, is the asset that is like making that debt completely liquid. Is like the warranty, basically, of it. In Maple, you have the decentralized version, which is Syrup. Basically, Syrup is a similar system. In this case, the institutions behind, they provide the digital assets. So basically, you can see that the API basically is the annual percentage yearly. It's higher, and it consists on, depends on which stablecoin you are providing, is slightly different. And this drips reward is basically one airdrop that they give it from time to time. You are seeing here a lot of numbers, and then you can ask, what are the risks here? What are the risks? Then I will tell you my opinion about the risk. Myself, I get like a pragmatic approach in how to measure the risks, because of course, if you are an auditor, you will say that the problem, they are the smart contracts, blah, blah, blah. Everybody says, like very, let's say, a specific case, it's, cases, but you need a general case to assess if you are going to put the money there or not. In my opinion, what is important is basically the partners and the backers of the protocol, and if the funders, they are anonymous or they are not anonymous, and if they raise money. All of this together is more or less the same topic. So basically, the founders of the protocol, they had to pass through all of this process, and basically the people behind, the investors, the biggest, let's say, partners or backers in DeFi, they are people that they know what they do, and basically that's a very big filter. And after that, basically, I will look to the TVL, so the total value locked, how much money is in that protocol. Like can be Aave is 25 billion, and how long the protocol has been around. So basically, if you have a protocol like Aave with a high total market size, it's one of the oldest protocols, and it has one of the biggest backers, so we can say that is really safe. So basically, they will tell you a lot of ways to basically to assess safety, but in my opinion, this is a very pragmatic one, and it really works because you can look to the, you as an individual, you cannot look to the code and start analyzing it. Is just way too inefficient. So basically, I will go to a different one. This is, maybe will sound complicated, but it's basically, this is interest rate swaps, but I can explain it in a more simple way than this. Actually, this protocol right now, it has $5 billion inside. And I remember I made a presentation about it when it was really small, and the token was like 15 times less valuable or something like that, because we were very excited and we invested in my company on it. And basically, I can simplify it. Basically, here it breaks, let's say, the stable coins. This is a stable coins. These strategies are about stable coins, but you can farm, let's say, with any asset. Bitcoin, Ethereum, with a lot of them. Basically, here, you can, let's say, you can lock this yield, 20%, 18% in these different stable coins. You can choose to lock this yield. If you think that the yield is high, that they are paying you very, very well, basically, then you can lock this for this number of days. And if you think that is very low yield, so basically you can buy what is called the yield token. So basically you are speculating in the yield. And if the yield goes up, basically it's like a lot of embedded leverage, but whatever, I don't want to complicate it. I will put you one example. For example, here in this stable coin, imagine that we put $10,000. So in this case, we are kind of buying it, this money at a discount, because basically this is the future yield. You have the maturity date here, this is the maturity, and basically you can see that you can make, from here to 24 April, you can make 3.5%, which is absolutely gigantic compared with a bank account. And in this case, basically, what you are doing is locking the yield till that moment. still you can collect the yield in any moment, but at maturity, this is the money that you get. So basically, you are like buying future money in some way. This protocol, this is like kind of farming as a service, because all sort of assets, they are getting listed here. And for example, some assets, like it can be, for example, syrup. We talked about syrup before. So basically, you can lock the current yield right now. Or, for example, Ethina, which is a very big protocol. Basically, in this case, they give this kind of protocol, they will give an airdrop. They give a periodic airdrop. So basically, this yield here is higher than the yield in the protocol that owns the stablecoin, because the airdrop is going to be given for the yield farmers, not for the principal token. So basically, here you can get even higher profitability than if you go to the protocol itself. So it's basically like farming as a service, you can say. So here, let's go to something more degen, like we say in crypto, some more degenerate with very high yields, if it even loads, let's say. I know that to farm stable coins will not make you attractive to women, okay, but it's a way to make your investments very safe, okay? So these are the crazy yields that you can get in DeFi sometimes. Here in this case, what you are doing is basically leverage farming. Leverage farming, it works in a way that basically you are taking, let's say, exotic assets, and for example, you can, basically you are doing an arbitrage between, oops, sorry for that. Basically, you are doing an arbitrage between the yield of a specific protocol and the borrowing rate. Basically, maybe you are getting 20%, as I saw you before, for one exotic asset, and you can borrow stable coins against it at 1%. So basically, you can buy more for the 20% yield, and you can borrow more, let's say for 1%, and you can do this again and again and again, and you can get very high yields. In this case, because you use leverage, in this case, if these stable coins, they lose the peg in one moment, they fluctuate, you could get liquidated, that's the risk. And I mean, this is more complex. And for example, you need liquidity. In this case, these pools normally they get completely empty. So in this case, you can see the liquidity here is really low. You couldn't get it, but if you are a farmer, normally you are on time for many of these opportunities, where right now we are a bit dry. But for example, this one, you can see you have $600,000 and the yield is quite high. So yeah, this is a principal token from Pendle against USDC Morpho. Yeah, so basically this is providing one of these principal tokens from Pendle and is borrowing USDC or Morpho again and again and again. So you reach this very high percentage. So this is another of the yield. This is let's say like the brother of Pendle, basically. This is just another place, interest rate swaps, where you can find very good yields. Here I sort by liquidity, because as I told you, the places with more liquidity, normally they are safer. So basically, you can just sort, and you can, let's say, research all of these pools to see if you agree with the assets. In my honest opinion, in this one is basically Go, the stablecoin from Aave, and the USD from Elixir. Elixir, they have partnerships with BlackRock and other big financial institutions. And actually, you can lock 20% yield for all of these days. So basically, if you put 10,000, you will get something like 1,000 in just this period. No, less than that, but something like that. And now I will tell you one secret farm. Let's do it. It's one a bit obscure, let's say, blockchain, but this is one of the cool things that you can do in DeFi. There is a lot of this stuff, but I don't want to make this super long. Basically, here you are providing liquidity for these two assets. In DeFi, when you provide liquidity, it's basically for people that they want to trade between these two assets. basically this blockchain is called Gnosis. Gnosis is a very old, let's say, protocol, and it's a blockchain too in DeFi. The team is very popular. It's one of the first Ethereum layer 2 or something like that, I believe. They have the Gnosis Safe, that is one of the best systems, whatever infrastructure. But let's say that here, when you provide these two assets, this asset, this is a stake DAI. So basically, this is a stable coin that is what is called an interest-bearing token. So basically, this stable coin is accruing yield automatically. I believe right now is something like 8%, something like that. And this is tokenized SPX 500. So basically, you are buying a tokenized SPX, and you are putting it together with a stable coin. The stable coin is giving you that yield, and on top, you are getting 20% in the token of Gnosis chain. What it is? It's not here. In the GNO token, that is basically the token of the Gnosis blockchain, which is one of the oldest protocols, which I believe is something valuable. They have a card, and they have a lot of infrastructure, basically. So in my opinion, imagine if you are trading in, let's say, in financial markets, this is way, way, way bigger the opportunity when you can have the SP500, and on top, you can get 20%. And here we can see the breakdown. So basically, sorry, it was not accurate. It's 20% altogether, 15% in the staking incentives GNO, and 6% DAI. So basically, this is an amazing opportunity compared with that. And the minter of this token, the minter of the SP500, actually now they are launching different assets. They are launching, I believe, NVIDIA, Tesla, and the Coinbase stock. So basically, you can enjoy these blue chip stocks, you can have them, and you can have a 20% on top, which is a massive advantage. And okay, I will leave it here because I don't want to drain you completely tonight, okay? Thank you. Where is the boss here?
The floor is open for Q&A, for questions. But maybe I will come with the first question. Fran, if you don't mind, could you go back to Hyperliquid? I think it was the third tab. Yeah, okay. So Fran is rushing through some new alpha here. What he forgot to mention, because I'm sure he tried to cover a lot of ground, is Fran is focusing on some advanced yield tools to increase the percentage of the yield that you get. But there is something called an airdrop. And some of you might be familiar with the concept. If you're using a new product, there is maybe a little reward for you if you are an early user. Could you just remind me, Fran, because you didn't mention it, what was the average airdrop for Hyperliquid?
Yeah, actually, I know people that they made only one trade in Hyperliquid and they got $60,000 in this protocol. Yeah.
Ladies and gentlemen, there you have it.
Yeah.
If you made the one click in Hyperliquid at the right time, now it's too late. But Fran, I remember, was talking about this here, not on the stage, but just having a conversation at the bar. 60K for one lucky click. Now, I'm not giving financial advice here, and this is one of many protocols. So this one was the golden goose. This one was the one with the big airdrop. But the opportunity is still there. So what do you care if you get 15% or 20%? If you use this, you have one transaction verified with your wallet, you're whitelisted for a 60K airdrop.
Correct.
Is there a question? I say it's too late. Now it's too late because...
It's not sure. I wouldn't be surprised if they do a season 2 airdrop. I wouldn't be surprised at all. Yeah. Basically, for example, this 7%, it comes from an airdrop. Basically, what they try to achieve with this is it's like a client acquisition cost. For example, what happened with Hyperliquid is a cool case because they said, okay, we will make a big airdrop. We will give a very big percentage of our token supply, a bigger than usual percentage. In this case, I believe they wanted to give. They gave 50%, if I remember well. So basically, that that attracted a lot of users because a lot of users they came, that generated a lot of fees. So in that moment, the people thought, okay, if there are so many fees, the valuation now is higher. So that attracted even more users, and then the fees they were even higher, and it attracted more users, and that created a snowball. And basically, this protocol right now, they gave the biggest airdrop in history, $2 billion. Very few months ago, they gave $2 billion to all the users, and right now they are generating. I don't remember, but it's something around 5 to 10 million fees per day, and they have around $5 billion volume per day, trading volume. So that's what happened, starting with, we will give you an airdrop, basically.
Can we see the user participation in the other protocols, or how it's running, if it's exponentially growing, so we can expect such a big airdrop from the others?
I mean, these protocols, I'm trying to keep it simple, so I saw these protocols, they are kind of old and very battle tested, and no, they don't give airdrops. The only one is here, is this one, and right now what happens with the airdrops is that basically this client acquisition process normally is more during the bear markets, because it makes like more sense, let's say. Now during the bear markets there are a lot of fees, and let's say that if you launch a token, it's good at moment to launch it, but let's say that the vesting period for the founders and everyone else, they are going to be maybe in the next bear market if the cycles continue. And so basically, let's say that it's cyclical, longest story short. So basically now we are in the moment of more collecting airdrops than trying to use protocols to farm airdrops, we call it. But it's very likely that it will happen again in, let's say, the next bear market in 1 or 2 years. Very probably we will pass through a similar period. Maybe the mechanics, they will be a bit different, because otherwise the users are learning and they will try to extract the maximum value. And now they are starting these industrial size farms, to extract that value. So we will see. But yeah, it will come back. It will come back eventually.
And one thing that is important to mention here, that we always say, you have to do your own research. There's a great opportunity in milking this guy because he tells you for free, but actually it's hard work. Fran does the hard work every day with the BitResearch, and ultimately it's your risk and your research.
I have 5 questions.
Go, attack.
No, okay. Can you explain to me, like a 5-year-old, like the 19%, the 16%, where is this coming from exactly?
Yeah, that's a good question. Yeah, I mean, actually, I wanted to say it, but yeah, there are too many things. I mean, the main source of yield in DeFi is leverage. That's the main.
What does that mean, man? I have, like, okay. I don't get it.
Okay, I tell you. For example, here, when you borrow one asset, the people that is borrowing stable coins, let's say if you deposit Tether, they pay you 4%. Why? Because the people borrowing Tether is paying 7%. So, and why? Because they want leverage. Very probably these people, they are buying more Bitcoin, buying more Ethereum. So basically, vast majority of the yields, for example, all of these yields, they come all from leverage. So basically, let me think how I explain it in a simple way. For example, it's always some sort of leverage. For example, the one on Zero Finance, all of this is leverage because basically they are asking for collateralized loans. This is private credit in this case. So basically there are institutions asking for over-collateralized loans. So basically they are paying more than what you are receiving. And here is exactly the same. Actually here you can see I don't know in which page it is here exactly now, but here you can see in some of these pages, I don't want to waste time, you can see all the collaterals here. So basically what you are getting here, the borrowers, they are paying more than this basically, plus you are getting the airdrop. That's how you are getting the yield. And for example, if you go like to Bitcoin, let's say, what is the funding? For example, in Bitcoin, this is something completely permanent. If you long Bitcoin, you pay annualize 11% basically. So basically, you can build products and derivatives, on this yield, and the open interest in this case is 150 billion. So the open interest in Bitcoin is 150 billion. Basically, 10% is 15 billion. So basically, if I simplify it, so we have 15 billion to share in DeFi every year, if I simplify it, basically. So most of it comes from leverage.
Okay. And what is the difference between a platform like Hyperliquid offering 16% and something like, I don't know, Nexo or Wirex, or because they're offering the same?
Yeah, in this case, Nexo and Wirex, in my opinion, these companies, they have me a bit confused because the kind of yields that they are offering, for example, high yields in Bitcoin and stuff like that I know the market quite well, and I have no idea how they are getting that yield. So it's very suspicious. So I prefer to use DeFi in this case, this kind of protocols. But I tell you that in this case, I explained you before how I assess risk. In my opinion, Hyperliquid is really safe. But for example, the market maker that I told you here, that is this vault. 1 second. Here, this is their market maker vault. Is not open source. But still, in my opinion, is way safer than Nexo and these platforms, because those platforms is very, very weird to me how they are getting such a high yield. Yeah.
Next question in the back, I come to you. Whoops. And also, Nexo, of course, they don't disclose what they're doing with your money to make the yield, and they give you a fraction of what they're actually making. Here, it's you directly who gets it, but also you carry the risk. Next question.
So I would like to ask about the institutions that are managing the lending of the money. Because if I understand it correctly, what we call leverage here is that there are institutions who let borrowers borrow money, and then they give us, if we give the money to the borrowers through their system, they give us interest, right? So can you please tell me a bit about what are the institutions which are running the borrowing side, the lending side?
But institutions, you mean because of Maple and Syrup, or you mean everything what I said today?
Let me try to reframe, because what you're telling us here is that there are these companies or projects which are lending money to customers and probably investors. And so here we get a percentage of that interest, right?
Yeah. Yeah, maybe I get you. Basically, if you want to borrow money here, you have to add more collateral than the money that you borrow. So basically, if you want to borrow $1,000, you have to provide at least 1,200 at the very least, and you have to maintain that level. You cannot borrow more than 80%. So basically, and here basically, if you have some digital asset like can be Bitcoin or Ethereum, something like that, that you are not using, but you have to provide it, then it's locked in the smart contract, and then you can borrow. But you cannot just borrow without providing anything, basically, if that's what you mean.
Okay, so then could you please explain the borrowing side? Because I think that's the interesting part. So there are people borrowing money on, let's say, 26% interest?
No, why you say such a high interest?
Just as an example, or 18%. If you're getting 16% on Hyperlink, then I would believe that if there is leverage, then people are borrowing at 18%.
No, I mean, what I was meaning about the leverage, that was a general explanation. This one, I was trying to explain it before, but it's a bit...
Yes, but as I understand it, probably with Hyperlink, it's going to be around 18-20%.
No, but here no one is borrowing. Here I was trying to explain you that this is what is called an automated market maker. This is a bit different.
But sorry, but in the case of lending funds, so...
in the case of...
could you please explain the process of how people can borrow and why they borrow with such incredibly high interest?
For example, here is the way you can... that they can borrow high interest. Maybe you are meaning here. Wait a second. Here, basically, you can see if this is what you're asking in syrup finance.
Yes,
These
yes,
are
I
the borrowing
understand.
rates.
I understand that, but
These are the borrowing
how?
rates.
Why are people borrowing money with such high interest, even if the collateral is your crypto? I'm
Yeah, I mean,
not sure I understand.
the people they do it is for leverage. I will show you one example here. It's just for leverage because they believe that the price will go high faster than the interest. Basically, it's long story short. For example, this is something that I use sometimes. Here, these people they are paying almost 0.1% per hour. Per hour. This is like crazy. This is the maximum of the maximum, basically because they are long leverage meme coins, and then basically they believe that this will go to the moon instantly, and they do crazy stuff like that. And actually, this protocol, what I do, actually this is big alpha. What I will tell you now, what I do sometimes is when the market is very overheated. Basically, I buy a meme coin like this one, I buy it, and then I short it. So basically, I am collecting 0.1% per hour. Instead of buying memes, I buy it and I short it, so it doesn't matter what the price does because I'm winning in one of both sides, but I'm collecting the yield.
Okay, so could you please just very shortly explain very easily how can one borrow and what is the reason they borrow for?
I mean, they borrow, I tell you, it's for leverage. The most common place to borrow is here. This is the most common place. The people, they borrow because they don't want to sell their Bitcoin and they want to have the money, maybe they have expenses. Or for example, here, this curve DAO token, let's see, I will put you another example. Look this one, this is CRV USD, this is stable coin. Here you can borrow it 8%, and then you can put it here and you can make 15%. So basically you are borrowing for 8% and you are making 15%. So basically you pocket extra 6%. You can do a lot of these strategies basically to make DeFi more efficient because this is like the beginning of a financial system basically, and there are a lot of these kind of holes to fill basically, yeah.
Okay.
There are lots of holes to fill that are very profitable until you fall into one hole and until the balance of the leverage pyramid shifts. So all what Fran is saying here, he's going to share those links in the Telegram group, and then it's really up to everyone to make their own informed decision and dig into where the yield is coming from, because there is a great risk with these high interest rates. You need to be aware of it. I think we have to wrap up. Is there a really urgent question you want to ask Fran now? Up with the hands. Okay, we have one closing question in the front, and then we are going to make a little announcement about next week, where we are going to talk about Austrian economics.
Very short with myself. Yeah, very short. No, it's not really short. Okay. Have you ever studied the correlation between the borrowing rates and the market? Because I remember, like, now the market has changed. I'm not really trading as much as 10 years ago, 8 years ago. But when the borrowing rate on Bitcoin and other crypto was very high, yeah, the market was overextended due to a correction. Yeah. Do you notice the same pattern? Have you studied that? And second question, what happened like 10 days ago when the market totally collapsed? There was 2 billion, probably even more losses overall in the market. There was any disruption in this DeFi environment?
Yeah, basically.
Quick answer, please.
Yeah, okay. Basically, about the first, yeah, it's all connected. Basically, if the market is overheated, basically the demand for leverage is huge. Basically, the yields, they are huge. And basically, when the yields are huge, then it has to go down. Because basically, when everything is so high, this is basically that they give you so much. It's like basically the price of money, let's say, is like the treasuries, you know. that this becomes like the price of money basically in DeFi. So basically,
Borrowing to
Yeah,
go
yeah.
long, and
exactly.
then the market
And you can
crashes.
use it actually to time tops and bottoms. And when you see that it's super suppressed, basically you can see a clear bottom signal. And when it's through the roof, it has to blow up because basically the price of money is too high.
Because it can help you trading the market on the on the underlying.
Yeah, you can have a look, yeah. And regarding the liquidations, nothing big happened in DeFi. What is the biggest that it happened, basically? I mean, it was the biggest liquidations in history, but I mean that DeFi worked as intended, basically, yeah. No big protocol blew up or anything, no. We are almost there. Yeah.
Thank you very much, Fran. Fran is not going to run away. You can meet him at the bar. Thank you. A lot of applause. Thank you very much. Fran is also going to publish many of these links in the Telegram group. Now, we want to make a quick announcement because today was really an advanced topic. It is not easy to follow, as you can see, and it is really risky. And that's why you should check out the BitResearch. They do research and they have different strategies that they analyze. So go talk to Fran, go talk to Dirk. They're both directors and founders of the BitResearch here today. You can talk to them at the bar. We also want to thank WH Partners, our preferred crypto lawyers. If you need legal advice or if it's maybe way too late and you needed legal advice a year ago, go talk to them and they will help you out. And then, of course, we want to thank Simply Staking, blockchain infrastructure company based here in Malta. I believe some of the engineers are also here. Francesco, where are you? I've seen there, he is over there. And they are actually transitioning this year into a more production-based company. So if you have an idea about the next DeFi protocol that you want to build to rock, go talk to Simply Staking and they'll help you out with that. Now, before we wrap it up, next week will be much more basic and to the fundamentals, where we're going to talk about a topic that might be very interesting. Damiano, please tell them what is going to happen next week.
So next week, we're going to have an event which is focused on broken money, the problems that broken money are creating, and on the solution, which is the separation between money and state. It's going to be a very curated evening in which a lot of things will be explained carefully. And I invite every one of you to bring with you anyone who's not prepared for these kind of topics and curious about these topics. We're going to try to keep it simple and very effective. And I can tell you that I've seen the material. It's very, very interesting. Doesn't matter how prepared you are in matter of economy. So please bring anyone you can next week. Thank you so much.
Thank you very much. See you next week.